Now we're continuing with accounts receivable in a more elaborate way. What we have here was called the account receivable ledger account, which is their control account. What does that mean? That means that it is one account that represents every account receivable. Think of yourself as a company that has maybe 10 customers. All right, you do work and you have about 10 different customers that are your accounts. They basically come in and buy your product, or you provide a service to these 10 different accounts. Let's call them, Target. Let's call them Best Buys. Let's call them Home Depot. Let's call them Lowe's. And those are the names of some of the folks you do business with. You earn money from these companies. You earn money from these clients. You earn money from these entities. And as a result of you earning money, you have a relationship where they don't pay you right away. They pay you over time. You provide the service, you send them an invoice, and in time, 30, 60, 90 days, they pay you for the invoice that you sent them for the services you've already provided. And we know when you provide those services, you generated the revenue. So in most cases, you're going to debit the account receivable for Lowe's, or debit the account receivable for Home Depot, or debit the account receivable for Best Buy, and you're going to credit revenues because you earned the money, you provided the service. As a result, the control account is one account that relates to every individual account receivable. Lowe's, Home Depot, Target. When you look at their balances, the 85, the 20, the 45, adding them all up equals the control balance of accounts receivable. So the account receivable ledger balance has what's called subsidiary ledger accounts. The subsidiary ledger accounts are your Lowe's, your Home Depot, your Best Buys accounts and their respective balances. All we're doing is getting the account balance and adding it up to equal the total control account receivable. Very simple to understand. That's why I broke it out that way. Once we get to that, we can then determine, based on experience with these guys, what amounts we're going to be collecting. We hope, and it is always our anticipation, that when we have an account receivable, we're going to get all the money. Lowe's, Home Depot, they're reputable companies. They're not going to stiff us. They're going to pay us on time and in time. And as a result, any invoice we have out there for services that we provided, we expect to get full payment. But we know in the real world that does not always happen. Even now, in light of what the world is going through, you may find businesses closing, situations happening, cash flow being restricted, and these businesses can't pay or won't pay. And as a result of that, you get what gives rise, it gives rise to what's called bad debt. Let's talk about bad debt. Bad debt means you're going to have some uncollectible accounts. These accounts are deemed uncollectible because, for one reason or another, the receivable is not coming in at 100%. Based on experience, we determine bad debt. There is an experience rating that we're going to get into on how to determine bad debt. And then there's two methods on recognizing bad debt and accounting for bad debt. So as we mentioned, bad debt is basically those receivables that you expect to get at 100% don't come in at 100%. And based on that experience rating, you then determine what your bad debt expense will be. Your uncollectible amount of those receivables will be. Plain and simple. I might have 100% in sales, but I won't get in 100% in cash collections. So as a result, based on my experience over time, I am going to predetermine how much of that I will not collect. And we'll get into that in one moment. More to come.